Hello, we will continue on the discussion of financial analysis. In the previous video, we have looked into the projected balance sheet that covers the first two elements, and for today, we will further continue on the other three. We start with the project liability items. Major liability items in a projected balance sheet may include accounts payable, short-term debt, and long-term debt. Accounts payable often are the results of accepting trade financing on inventory purchases. If higher sales require higher inventory, the increase in inventory will likely lead to an increase in outstanding accounts payable. Thus, accounts payable will likely change in proportion to sales. Projection on short-term debt, in other words, it also being called notes payable, often depends on the organization's financing policy. To accommodate a sales increase, a business may choose to increase short-term financing at a certain rate each year. That's why sometimes when the time needed, there will be short-term financing be involved in certain companies. Long-term debt is usually left unchanged in initial projections and may change in the future if additional financing is required. Let's move on to the fourth element of projected balance sheet, which is project equity items. The owner's equity, in terms of the stakeholders or the stockholders' equity, and retained earnings are the two common sources of equity financing. Similar to projecting long-term debt, the owner's equity is also left unchanged in the initial balance sheet projections. The organization may issue additional equity depending on future financing circumstances. If a shortfall in asset financing through other means exists, the organization needs to project an increase in either the owner's equity or long-term debt. So there are two options here, whether you increase the owner's equity or you take another debt or loan in order to make up the deficit. Projecting retained earnings essentially relies on the net income projection in the projected income statement for the same future period. The last element is project discretionary financing. A projected balance sheet may not be balanced upon initial projections of various balance sheet items. Total projected assets may exceed total projected liabilities. So this is very common. The total projected assets may exceed total projected liabilities and equity. It is not balanced, resulting in a fund shortage in future financing. Furthermore, if the total projected assets are less than the total projected liabilities and equity, a fund surplus exists. A fund deficit or surplus in projected financing must be balanced out through discretionary financing. This is the term, discretionary financing, by adjusting projections on long-term debt or equity. A projected balance sheet becomes balanced when the projected increase in long-term debt or equity equals the amount of fund deficit in initial financing projections. Okay, a projected balance sheet can also become balanced if business uses the projected fund surplus to further increase asset investment. So, further increase asset investment or reduce initial financing projections. This is an example of the projected balance sheet. So, as highlighted earlier, it is meant for planning. So we have year 1, year 2, and year 3. The same elements appear. We have the current asset, we have the cash, inventory, prepaid insurance, prepaid rent, prepaid expenses because it's not being paid yet. So you can just being put up like a projection. And then we have a fixed asset, okay, furniture and fixtures, okay, maybe for the first year you need, but you do not need for the following year, year 2 and year 3. Quality assurance and testing equipment, safety and security system probably occur in the first year. So the total asset increases from the first year, second year, and the following year. When we look at the column for liabilities and equity, similar to the asset just now, you have year 1, year 2, and year 3. You have the account payable, tax payable, not in the first year. Normally tax occur after a year of operation. So you have year 2 and year 3. Shareholders equity, right? So you can have shareholder equities, paid in capital, and retained earnings as such. So we have amount of total equity for the first year, second year, and the third year, which is more than before. The total liabilities and equity can be calculated as such, and the net worth of the company can be projected as such. So we can see that the net worth of the company increases by $2 million in the final year. That's all for today. We will continue on the income statement in the following video. If you have any queries, you may put a comment in the YouTube link. Thank you.